Good afternoon. Thank you for joining us for this webinar, Capital Expenditures and Criteria for Evaluating Business Investment. I'm your moderator, Renee Goodnow from the New York Small Business Development Center. Today's host is the Pace Small Business Development Center. Pace SBDC is part of the New York SBDC's network of 22 campus-based centers and outreach offices across New York State. The New York SBDC is a U.S. Small Business Administration resource partner. Our free services are made possible by funding from the SBA, New York State, and our host campuses. Now that we went through some housekeeping items, joining us to lead things off and introduce our presenter is Pace SBDC Director, Andrew Flam. Andrew, I'll turn things over to you.
Super. Thanks so much, Renee. Good afternoon, everyone. Thanks so much for joining us. As Renee mentioned, my name is Andrew Flam. I'm the director of the Small Business Development Center here at Pace University. We are based in Lower Manhattan, and really appreciate you all joining us today. Wanted to sort of touch base briefly about who we are, what we do, and then introduce our speaker today, my colleague here at Pace University, Padma Kadiyala. So as Ray mentioned, I guess our center is one of 22 located throughout the state. Our focus is on providing one-on-one business advisory services to both existing small business owners as well as aspiring entrepreneurs, helping them in a wide range of issue areas, including access to finance, developing marketing strategies, operational challenges you may be having, as well as looking at procurement opportunities for your growing business. So if any of these strike a chord, we'd be more than happy to work with you. Our team of full-time business advisors works with individuals kind of on a day-in, day-out basis, and that's kind of what they're doing, helping folks kind of get through challenges and build and grow their business here in New York State. I should reiterate and say frequently, all of our services are offered at no cost. So we do look forward to working with you if we're not working with you already. I will add our contact info into the chat shortly, as well as a link to a request for counseling services form. Just takes a few minutes to complete if you send that along, and then we'll be able to arrange a one-on-one session for you. And again, all those services are offered at no cost. As part of our services, we also do host a wide range of webinars. Today, we're delighted to have my colleague Padma kind of join us for this session on capital expenditures and evaluating business investment, including looking at how you can build and grow your business, thinking about kind of these big expenditures and undertakings as you're looking to kind of build and grow your business are really, important strategically. And I think our business advisors, they can kind of provide some great insights and help you identify the corresponding financial wherewithal to be able to pull some of these expenses off. So if this is something you're considering, again, so would certainly encourage you to take advantage of our services. So today's session is one of a wide range of sessions that our center hosts, as well as all of my colleagues throughout the state. So we do have an extensive webinar calendar that I will share a link to you as well. Again, these sessions are also available for free, so please do take advantage, not just of the sessions that we host ourselves, but as well as those that my colleagues are hosting elsewhere in the state. And finally, for those businesses who do have existing ventures, if you've been operating with and kind of are faced with challenges resulting from COVID-19. As many of you hopefully do know, there are a wide range of financial assistance programs that are in place presently to help alleviate some of these concerns. There are a wide range of grant programs, both through government sources as well as through the private sector, as well as a wide range of lower interest loan programs that are really targeted to help New York State small businesses kind of get through this challenging period and hopefully develop some opportunities to build and grow on the other side. So if you want to learn more about the programs that do exist, and again, to speak to a business advisor, we'd be happy to work with you, and I'll put in a link in the chat that has a reference point to some of these programs that are in place. Again, many of these are kind of recovery programs, but I think there are a wide range of programs both through the U.S. Small Business Administration and other sources of capital that can help identify prospective assistance in terms of building out and fleshing out some of the projects that you might be considering on the capital side, and that I'm delighted that Padma has agreed to kind of walk you all through today. So that's our brief summation of kind of who we are, what we do. We look forward to working with you, and so please, you can join us today. And with that, I'd like to turn the floor over to my colleague here at Pace University, Padma Kadiyala. She's a professor here at the Lubin School of Business here at Pace. Padma, it's all yours.
Thank you, Andrew. Thank you, Renee. It's my pleasure to join you and an honor to be invited to talk to you about a topic that's near and dear to my heart and to my research agenda, capital expenditures and criteria for evaluating projects. I had sent through Renee a question that I wanted to hear from you, your responses. When you get a chance, please do type in your response in the chat box. The question was, please share with us the decision-making process you follow when buying new equipment for your business. That was supposed to segue into today's session, touch upon topics that you already may be familiar with and hopefully introduce new topics and new tools that you might be able to use to grow and expand your business. So I hope you can all see my slides. The topic is capital budgeting. And I want to spend just a few seconds on the title, capital budgeting. So here we're talking about how do you budget to make capital investments. The word capital in finance is used to refer to long-term investments that require long-term sources of financing. So the steps that are involved in the capital budgeting process, first identify the project. So when we say project, I'm talking about should you go into a new product? Should you go into a new market? Should you acquire a competitor? Those are all projects. In a large corporation, there would be a strategy group that would identify these projects after having conducted a SWOT analysis. In a small business, perhaps it's the owner, proprietor, who is the strategic thinker. And so it would be up to the owner, proprietor to figure out what the projects are, what is the menu of projects that might attract investment. You would then estimate the cost associated with each project. What are the costs associated with getting the project off the ground? What are the costs associated with the day-to-day management of the business, what we call working capital? And what are the operating costs of running this business on an annual basis? You would then estimate the future cash flows. So in finance, I tell my students that we are only concerned about what's going to happen in the future. Right? What happened in the past is not relevant to the value of your investment today. What is relevant is what is going to happen in the future. So you may wonder, when we are asked to estimate future cash flows, how far into the future should you go? Well, at a minimum, somewhere between 7 to 10 years. So 7 to 10 years is a good forecasting horizon. Beyond year 10, you have to make a decision as to how you would treat subsequent cash flows. The typical treatment is to treat cash flows beyond year 10 as a perpetuity, and then use the tools that we have in finance to value a perpetuity. Also, the word cash flows. I'll talk more about what this specific, what these words refer to in just a second. Estimate the discount rate. The discount rate is your cost of capital. So you would have to estimate what is your cost of capital and then apply a decision rule. Now, each one of these steps that I have already outlined deserves consideration on its own, meaning we would spend close to 4 or 5 sessions on each one of these steps. Unfortunately, today we only have an hour's time, so I'm only going to focus on the decision rule. What decision rules would you apply once you have a set of cash flows identified for a project?
Padma,
What
we did get a couple of answers that came in. Did you want me to read those off quick to your question?
Thank you, please, Renee. Yeah, if you could.
Sure. Return on investment was one, and then
Mhm.
the other one was capital needs and cash flow.
Well, thank you very much, Renee. Definitely, I'm going to address return on investment, and I hope I address the other answer, capital needs, and what did you, I'm sorry, Renee, what was the second part of it?
Capital needs and cash flow.
And cash flow, yeah. And I will talk about cash flows as we go through this seminar today. Now, what are the requirements for a decision rule? So in finance, we're very particular about the properties of a decision rule. The first property or a requirement is, does the decision rule adjust for the time value of money? The concept of time value of money simply means that $1 today is more valuable than $1 tomorrow, because you can take that dollar, deposit it into your bank account. And I recognize that today banks don't pay very much on your deposits, but still, whatever they pay, it's bigger than zero. And therefore, you're guaranteed to have more than $1 next month, next day, whatever. And that's the time value of money. That interest that you're giving up by not having that dollar today, or that return more precisely. Second requirement is, does the decision rule adjust for risk? In your world, as in mine, risk and taxes are a constant. So how do we adjust for risk? Third, does the decision rule provide information on whether we are creating value for the firm? This value creation is critical in finance. If you are a private company, value matters. When I say value, I'm talking about your market value. That is, what is the price that someone else is willing to pay to acquire your business, lock, stock, and barrel, right? How much will they pay to buy your company? That is the market value. So at any point, even if you're not looking to sell, right, you want to be able to maximize the value of your company, because you are the owner. And as an owner, you want to maximize your wealth, which is the same thing as maximizing the value of your organization. So any decision rule will have to have that objective in mind. Is it selecting a project that maximizes the value of your firm? Now, if you're a public firm, market value is just as important, because that affects the share price. Every day, the share price, every minute, every hour, the share price is changing on the stock exchanges. And the share price is changing because market participants are changing their perception of your company's value. So whether it's a private company or a public company, the market value matters, and maximizing the value is the objective of an owner. Let's look at the various decision rules with an example, a very simple example of a project that involves building a warehouse. Okay? Maybe you want to stock inventory and you've been leasing space, but now you'd like to build your own warehouse in order to stock inventory. Okay? So along the x-axis in the first row, I have the year. Okay? Year 0 refers to the year before the project takes off, before you start to see income being generated by the project. So year 0 is like a catch-all for the entire time period that it takes to launch your project. Year 1 is the first year when you'll start seeing some revenues, year 2, and so on. And I terminate these projections in year 10, so year 3 to year 10. Why year 10? Well, it's just a rule of thumb, because it's easier to forecast up to 10 years ahead. Beyond 10 years, who knows? It's anybody's guess. Right? So we have an explicit forecast horizon, which depends upon the volatility of your business, but it could be anywhere between 7 to 10, as I mentioned before. The second row has the cost of the building. There is a negative sign in front of 120,000. The negative simply means it's a cash outflow. That's how much you will have to spend out of your pocket in order to build this building. In the third row, I have an opportunity cost, and that is a negative 30,000. Again, the negative indicates that it's a cash outflow, money out of your pocket. And what might an opportunity cost be? Well, maybe you're building this warehouse on vacant land, and you've been leasing that land to somebody who's been using it for parking, perhaps, or been using it for some other purpose, and you've been receiving some lease income from that vacant land. Now, by building this warehouse, you're giving up that rental income, and that is an opportunity cost that you must consider in the initial investment. From year 1 onwards, so in year 4, I have increase in cash flow. Okay, the numbers are 10,000 in year 1, $25,000 in year 2, and in years 3 to 10, it's $40,000. Okay, I'm assuming that it's the same. Okay. Now, when we say cash flow in finance, we're not talking about income. It's different from income. Okay. Income, I've indicated in the last row of this table. Okay, so before we talk about the difference between cash flow and income, let's total these cash flows. That's row 5. So in year 0, we have a total cash flow of negative 150,000. In year 1, 10,000. In year 2, 25,000. And in years 3 to 10, 40,000. Now the increase in net income is negative 5,000, 10,000 in year 2, and 25,000 in years 3 to 10. So what is the difference between income and cash flow? Very simply, if you don't consider a whole lot of other things, the difference between income and cash flow is that cash flow is equal to income plus non-cash expenses. The biggest non-cash expense that most for-profit businesses will have is depreciation, okay, or amortization. So the non-cash expenses are depreciation, amortization. These are non-cash, so they have to be added back to the net income to get the cash flow. So we're interested in the cash flow rather than in income because it is the cash flow into and out of your bank account that determines what the value of this enterprise is going to be, right? It is not the income, which is an accounting measure, but the cash flow, the actual flow of cash into and out of your bank account at the end of the year. Now, the reason we have depreciation is because it helps businesses reduce the taxable expense. And so it's a fictitious expense. It's only there because it helps businesses lower their tax bill. But because it doesn't represent an actual outflow of cash, we add it back to net income to get cash flow. So that's the difference between cash flow and income. And in finance, our focus is on cash flow rather than on income. So let's look at our first decision rule, payback period, which measures how long it takes to recover our initial cost. How do you compute the payback period? You estimate the cash flows. You subtract the future cash flows from the initial cost until the initial investment has been recovered. And the rule is except if the payback period is less than some preset limit. So let's calculate the payback period for our project. So assume that we'll accept the project if it pays back within 5 years. Now, where does the 5-year payback period come from? Well, maybe it is something that you have come up with from your experience working in this industry. From your experience, you've found that projects that pay back within 5 years tend to be winning projects. Anything that takes longer than 5 years to pay back is a losing investment. So that's how you've come up with this 5-year benchmark. So in the table, I accumulate the cash flow starting in year 1. So the numbers that I have for cash flows, I'm adding up. So year one is 10,000. Year two, you add up the cash flow from year two to the one in year one, ending up with 35,000. In year three, we end up with 75,000. In year four, we end up with 115,000. And in year five, we end up with 155,000. I stopped there because by year five, you've started to exceed the initial investment, which was 150,000. So it takes somewhere between the fourth and the fifth year for this project to pay back. And more precisely, it's for 7/8 of a year to pay back the initial investment. Since this payback is less than our cutoff of 5 years, we would say we should go ahead and invest in this project. Now, what are the advantages and disadvantages of payback? Advantage, it's easy to understand. Adjust for uncertainty of later cash flows by discounting later cash flows. It's biased towards liquidity, meaning when we say liquidity in finance, we're talking about how quickly can we recover our investment. So it's biased towards that property. The disadvantage, it ignores the time value of money. It requires an arbitrary cutoff point, like 5 years in our example. It ignores cash flows beyond the cutoff date. So if there is a big lottery payoff in year 7, but the payback cutoff is 5 years, we might be tempted to say, oh, this is not a worthwhile project, ignoring completely that big lottery payoff in year 7. It is biased against long-term projects such as research and development and new projects that take a while to pay back. Average accounting return. This is very close to the return on investment that came up as one of the answers. In finance, we want to be very precise as to what we're measuring as investment and what we're measuring as return. And so the average accounting return defines the return on investment as average net income over average book value. So we're approaching it from the left-hand side of the balance sheet. So what is the average book value of your total assets? And what is the average net income? The average is over the life of the project, over the explicit forecast horizon of the project. Note that the average book value depends on how the asset is depreciated, because every year the book value drops by the amount of the depreciation. Now, for this decision rule as well, we need to have a target cutoff rate. Okay, so the rule says accept the project if the average accounting return, abbreviated as AAR, is greater than a preset rate. Assume we require an average accounting return of 25%. Again, how did we arrive at this 25%? Maybe through our years of experience in this business, in this industry. We know that riskier projects in this industry need to return at least 25% to add value to our business. Any risky investment that generates less than 25% is going to hurt our value. So this is a cutoff that you have maybe come up with from your years of experience in the field. Okay? But recognize that this return does not take risk into account, and we'll talk about that in just a second. Coming back to our example, the average net income. Now notice that we're now talking about income rather than cash flow, because that's the way the AAR is measured. The numerator has the average net income, not cash flow. So take the average of net income, that works out to be 20,500. Average book value is always 1/2 of the initial investment if you have depreciated the asset down to 0 over its life. The book value works out to be 75,000. So the average accounting return works out to be 20,500 over 75,000, which is equal to 27.3%. Since this number is bigger than our cutoff of 25%, we would accept the project. It's generating a higher return than the minimum, the bare minimum of 25%, so we should go ahead and accept the project. What are the advantages and disadvantages of this rule? It's easy to calculate. Needed information will usually be available. Our accountants in the business will have computed the net income over the life of the project. The disadvantage, it is not a true rate of return because it ignores the time value of money, right? When you take an average, you're simply adding up the cash flows and dividing it by the number of years. So you're completely ignoring the time value of money. It uses an arbitrary benchmark cutoff rate. So that cutoff rate of 25% is arbitrary in the sense that even though our years of experience have told us that that cutoff is appropriate, it does not still adjust for risk. We may not have seen the entire gamut of projects during our years of experience. Some may be less risky than the usual. Some may be more riskier than the usual. So should we adjust the target based on the risk of the project? We don't know. The average accounting return doesn't tell us how we should adjust the return for the risk. And finally, the biggest disadvantage is that it's based on accounting net income and book values, not cash flows and market values. And in finance, our emphasis is always on market value and on cash flows rather than income and book value. So it violates many of the concepts we hold dear in finance, and so we don't like this decision rule very much either. Net present value. Net present value, the rule, let's first get to the rule. It says accept the project if the net present value, abbreviated as NPV, is positive, and reject if the NPV is negative. How is the NPV calculated? The NPV is the difference between the present value of the expected future cash flows and the cost of investment. Okay. So there's a lot in that one line. The NPV is simply the difference between two quantities. One, the present value of expected future cash flows, and the second, the cost of investment. A positive NPV means that the project is expected to add value to the firm and will therefore increase the wealth of the owners. And that is the objective of an owner, to maximize their wealth. So NPV fits very nicely into the objective of the owner. Now, to calculate the NPV, we have to calculate a present value. Okay. To calculate a present value, we simply take the cash flow in any year and we divide that into 1 plus the cost of capital raised to the power of the year in which we received the cash flow. Okay, so let me repeat that. The present value is equal to the cash flow in any given year over 1 plus the discount rate raised to the power of the year in which the cash flow is received. Now, in order to figure out what is the discount rate, cost of capital, required return, all three are the same thing. Here, we're going to assume it's 10% in this example. In the real world, how do you come up with the required return? In the real world, the required return is how much can your shareholder get if they took the money that you were going to invest in this project and instead you decide to pay it out as a dividend to your sharedholder took that dividend and invested it somewhere else. What is the rate of return they can get from that investment somewhere else? That is the rate of return you should be using to calculate the present value. In equilibrium, that rate of return has to equal your cost of capital. What is the cost of capital for a business? Again, Cost of capital, I typically would spend about 3 sessions, 2 hours long each, and would go into great detail about how you would calculate the cost of capital. But to summarize, the cost of capital is the weighted average of the cost of debt and the cost of equity. Debt and equity are the 2 main sources of financing for any business. So figure out what is the post-tax cost of debt. And remember that interest expense is tax deductible. So the post-tax cost of debt, how much is that? How much is the post-tax cost of equity? And take a weighted average, okay, where the weights are the proportions of debt and equity in the total capital. Okay. Now, that still leaves us with another question. What is the cost of equity? Right. So like I said, I would spend a few class sessions on determining the cost of equity. But here I would simply say you could use something like the capital asset pricing model or the CAPM to figure out the cost of equity. Admittedly, estimating the cost of equity is challenging, especially if it's a privately owned business. And if you need help for your business, of course, you can reach out to Mr. Flam, who can help you with that. But let us say, for the sake of this example, that our required return / cost of capital / discount rate is 10%. To calculate the NPV, we figure out what is the present value of expected future cash flows. So we have the negative 150,000 is our initial cost. That shows up exactly as is because it's incurred right away. So its present value is exactly equal to the value that we have in the table. In the next year, we receive a cash flow of 10,000. Its present value is 10,000 over 1 plus 0.1 raised to the power of 1. In the next year, the cash flow is 25,000, whose present value is 25,000 over 1 plus 0.1 raised to the power of 2. 2 because it was generated in year 2. In year 3, the cash flow is 40,000. So 40,000 over 1.1 raised to the power of 3. And so on until the last year. So in our example, we are assuming that the project terminates in year 10. So we only have to go up to year 10. So the present value of the last cash flow in year 10 is equal to 40,000 over 1.1 raised to the power of 10. Add up all of these things. We're allowed to add these cash flows because we've already adjusted these cash flows for the time value of money. Once we have adjusted these cash flows for the time value of money, we are then allowed to add and subtract these cash flows. So adding all of those cash flows with the appropriate sign, the sign indicates whether it's an outflow or an inflow. A negative sign, to repeat, is an outflow. A positive sign is an inflow into our bank account. So with the appropriate signs, we add up the present values and we generate an NPV of 56,113.26. The units on this number is dollars. Okay? With regard to the 2 decision rules that we've already considered, the payback period, the unit is number of years. The average accounting return, the unit is the percent. In the case of NPV, the unit is dollars. Okay? Now, the decision rule says that if the NPV is positive, we should accept the project. Okay? Because the NPV is positive, we would go ahead and invest in this project. Now, let us say that we increase the required return to 25%. Now, how does the required return go up? Well, the required return might go up because the cost of debt has gone up or because the cost of equity has gone up. Typically, it is the cost of equity that will increase to reflect that the project is now riskier than initially anticipated to be, right? So it is the cost of equity that closely reflects the risk associated with the project. So we like the NPV rule in finance because it satisfies all the requirements for a good decision rule. So if I scroll back to a previous slide where I listed out the requirements for a decision rule, the NPV satisfies all three. It adjusts for the time value of money. It adjusts for risk by letting the discount rate reflect the risk. And third, it provides information on whether we are creating value for the firm. The NPV, the dollar amount, is the increase in the value of our business as a result of investing in this project. So right away, we can go from the decision rule to how it affects the market value of our business. And that's what makes NPV very attractive as a decision rule, unlike the two decision rules that we have already considered, namely the payback period and the average accounting return. If you change the required return to 25%, the NPV now becomes negative. A negative NPV tells you you must reject the project, okay, because it hurts the value of our business. Therefore, we should reject the project. The last decision rule that we're going to consider today is the internal rate of return, abbreviated as IRR. IRR is the discount rate that makes the present value of future cash flows equal to the initial cost of investment. Equivalently, it is the discount rate that gives a project a zero NPV. So what is the required rate of return at which our project will end up with a zero NPV? If you like, you can think of it as a break-even rate of return. And the rule says undertake the project if IRR is bigger than R, which is our discount rate or the required rate of return. In other words, if the project is generating an internal rate of return that is bigger than our cost of capital, then we should invest in the project. It makes a lot of intuitive sense, right? If you're investing in a project and it's generating a return that is bigger than the cost of financing that project, then yes, this is a good investment. On the other hand, if it is generating an IRR, which is less than our cost of capital, it's a bad project and we should reject it. Now let's calculate the IRR for the warehouse project. We want to set the initial cost of investment equal to the present value of future cash flows. So the cost of investment is $150,000. It has to equal the sum of the present value of all future cash flows. I already walked you through how you calculate the present value. The only difference here is we don't know what that R is in the denominator. That's the R that we're looking to solve for. That's our IRR, okay? So we don't know what that R is. We're going to solve for it, okay? Now, unfortunately, it is impossible to solve for this numerically, meaning there is no simple formula that will give us an answer for R. You have to go through a numerical procedure. Unfortunately, Excel will solve it for us. Okay? So in Excel, if you're all familiar with Excel, you would simply go into Excel and enter equals IRR, open parentheses, you would list out all the cash flows starting in year 0 and ending in the last year, close parentheses, and Excel will spit out the IRR for us. Okay. Your calculators, if they have financial functions built in, can spit out the IRR, but you will need an electronic device to solve for the IRR. It's not easy to solve for the IRR using a simple calculator. But fortunately, we all have access to Excel and financial calculators, so we can solve for the IRR. It turns out that the IRR is equal to 16.96%. Okay. In other words, if you spend $150,000 to build a warehouse and to give up the rent that we would have received from that vacant land, in exchange, we would receive cash flows of $10,000 in year 1, $25,000 in year 2, and $40,000 in each of years 3 to 10. This project will generate an annualized rate of return. So remember, this rate of return is annualized. On an annual basis, we will earn a return equals 16.96%. Okay? Now, what to make of this 16.96%? Well, compare it to our cost of capital. If our cost of capital is 10%, right? Well, our project is generating a return in excess of the cost of capital, and therefore we should accept the project. However, if the cost of capital is 25%, then the IRR is below our cost of capital, and we should reject the investment. Okay. So the units for IRR is in terms of a percentage as opposed to NPV, whose units are in dollars. Okay. Now the IRR also satisfies all the requirements of a decision rule. Let me quickly go back to that slide where we had the requirements. Does it adjust for the time value of money? It certainly does, because we're equating the initial cost to the present value of future cash flows. So it does account for the time value of money. Does it adjust for risk? It does, because we're going to compare our IRR to our cost of capital, and risk is built into our cost of capital. Right? Higher the risk, higher the cost of capital. Does the decision rule provide information on whether we're creating value for the firm? Yes, it does, because it turns out that if the IRR is bigger than the cost of capital, we are increasing the market value of our business. Even though the answer is not in dollars explicitly like it is for NPV, the IRR can still tell us indirectly whether we are creating value for the firm or not. Now let's compare and contrast the NPV with the IRR. The advantage of an IRR, knowing a return is intuitively appealing, right? If you have to go in front of a board of directors to defend your choice of a project, and you tell them that the NPV of the project is $53,000, inevitably the question is going to come up, what does that mean? Can I cash out and get my $53,000 right away? And the answer is yes, if you're a publicly owned business, because your share price, the increase in your market cap, in other words, would exactly be equal to the NPV of the project. But in a private business where you can't really trade your shares on an exchange, it's much more difficult to translate the NPV into a liquid measure of value. But you can tell the board member what the internal rate of return is, and they would understand intuitively what that means. They know what the cost of capital of financing this business is, and if they're told that the IRR is 16% when the cost of capital is 10%, they get it right away. Oh, yes, this is a good project. So it's very intuitive. And you might well be aware that in the business world, what is intuitive is much more appealing than what is abstract. It is a simple way to communicate the value of a project to someone who doesn't know all the estimation details. So when you say, oh, the NPV is the sum of the future cash flows, the present value, blah, 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 people are going to look at you blankly. But if you say my project has an internal return of 16%, people get it. They understand what a return is. Right? So once again, it's intuitive. If the IRR is high enough, you may not need to estimate a required return, which is often a difficult task, especially for a small business where it's difficult to estimate what the cost of capital is. If you have a high enough IRR, you might intuit that there is no cost of capital that's going to be higher than this IRR. So in other words, we should right away go ahead and invest in this project. Right? So if the IRR is big enough, is large enough, you may not need to have to go through this process of estimating a discount rate that you need for the NPV. So for these three reasons, the IRR happens to be the most widely used decision rule in the business world. So somebody from Duke University went out and did a survey of all large businesses, and they found that the IRR was the most popular decision rule, followed by the NPV. And people did use the payback period, but the payback period is used mainly for small ticket expenditures. So for instance, should the company go out and get another printer? Should the company go out and buy another car to add to its fleet? So small ticket, relatively small ticket items, for those types of expenditures, it's okay to use the payback period because you would not be too far away from what the IRR would say anyhow. But for large expenditures where you have to estimate cash flows for the next 10 years, the payback period simply doesn't do the job. The average accounting return also does not do the job because it completely ignores the risk associated with the project, which is a big deal if you're forecasting out to 10 years in the future. And so we're left with the NPV and the IRR, and the IRR is much more intuitive than the NPV. Having said all that, I do want to leave you with some of the drawbacks of IRR relative to NPV. Both of them will generally give us the same decision, meaning if one says to accept the project, so will the other. If one says to reject, so will the other. However, there are exceptions. First is when there are non-conventional cash flows, meaning cash flow signs change more than once during the life of the project. In the warehouse example, the cash flows change sign only once, going from year 0 to year 1. But this may not always be the case. A project may require subsequent investments down the road. So there may be years when the cash flows are negative. So if there are sign changes, multiple sign changes, then the IRR is not reliable. Because of the mathematics of having to calculate an IRR, the IRR simply will not work in those situations. When you have mutually exclusive projects, meaning you have two choices and you can only invest in one, you can't invest in both. An example might be you have this vacant land, you can either build a warehouse or you can build, let us say, a factory. Okay? If you build a factory, you have to give up the warehouse. If you build the warehouse, you have to give up the factory. So those are called mutually exclusive projects. And you're trying to determine what is the best use for this land, let us say. So you've drawn up the cash flows for the factory and for the warehouse, and you've gone through your entire analysis. You've come up with the NPV and IRR for the warehouse. You've come up with the NPV and IRR for the factory. And now you're trying to use the NPV and IRR to figure out which one is better. Well, you should go with the NPV. Whichever project has the higher NPV is the project that's going to increase the value of your organization. The problem with the IRR in this situation is that in the case of IRR, it tends to favor projects with smaller initial investments. So IRR favors smaller scale projects over bigger scale projects, whereas the NPV has no such bias. It is not biased towards smaller projects or towards larger projects. It simply gives you the value, the bottom line created by investing in a project. So when there is a conflict between the NPV and an IRR, NPV directly measures the increase in value to the firm, and therefore you should go with the NPV. And the IRR becomes unreliable when you have non-conventional cash flows, which is where there's more than one sign change during the life of the project. And second, when you're evaluating mutually exclusive projects and you have to choose between one or the other. In conclusion, capital budgeting in practice, we should consider several investment criteria when making decisions. NPV and IRR are the most commonly used primary investment criteria. Payback is a commonly used secondary investment criterion. Okay, that's all for the seminar today. And I'm happy to take any questions from the audience.
Thank you. Andrew, did you want to say anything before I jump into questions?
I briefly was supposed to say thank you so much, Padma, for a very insightful session. I think hopefully those in attendance, you get a sense of the kinds of review and the kinds of things you need to consider when looking at prospective investments in your business. So I think this kind of gives you the tools to assess prospective opportunities and hopefully make your strategy sessions with your business advisors kind of that much more fruitful. And I think the one thing I did want to add was a late breaking addition link in the chat that I added was, I think I made reference to some prospective sources of financing that may also kind of look at, some of the points that Padma was kind of really digging deeply into in terms of sources of debt and equity for your project. So you do consider these and click on that link to some of the SBA financing programs that may be a benefit that could support the capital you need to have in hand to take on some of these opportunities. So Padma, thanks so much again. I really appreciate it. And I will step aside again. Thanks.
You're very welcome, Andrew. Thank you.
Yes, thank you. I have the first one for you. It's jumping back a little bit in your presentation. How are you calculating the opportunity cost for the project?
A simple example would be, let us say that you have an opportunity to get an MBA, right? So an opportunity cost in that example would be the wages you're giving up by entering into a full-time program. That is an example of an opportunity cost. In the case of this warehouse, I was saying that maybe you're building this warehouse on a vacant piece of property, and maybe you're receiving some rental income because somebody is using it as parking, right? Game day, maybe it's close to the stadium, and you're getting some income from the parking revenue. So you would simply figure out what is the present value of the income that you're giving up from now to 10 years from now, and that becomes your opportunity cost. Hope that was helpful.
Yeah, if there's any follow-up on that one, Yolanda, you can let us know. How do you account for risks and certain assumptions when determining the IRR?
So when calculating the IRR, you don't have to account for risk, right? The cash flows will probably reflect the risk, meaning that there would be a greater volatility in the cash flow, meaning that cash flows are all over the place for riskier projects, and for safer projects, they are level and stable. To that extent, the cash flows would reflect the risk. The IRR itself, beyond that, does not reflect the risk. It is what we're comparing the IRR to in deciding whether or not to invest in the project that reflects risk. It is the cost of capital that reflects risk. Right? The higher the risk, the higher the cost of capital, and that is the hurdle that the IRR would have to jump in order to be acceptable. So in that sense, the risk is being incorporated into IRR.
Thank you. Another one on risk. Could you further explain where do we find the required return for the risk? Are there proxies people turn to in order to find this rate of return of capital?
Oh, that is the billion-dollar question. Even seasoned professionals get it wrong because, as you can see, the discount rate is a very important parameter for calculating present values. Now, there was a discovery back in the 70s by two economists who won the Nobel Prize in Economics for addressing this very issue, for how do you reflect the risk in the required rate of return. The result is a theory called the Capital Asset Pricing Model, or CAPM for short. So people use the CAPM as a tool to figure out what is the required return given the risk of the project. For large publicly traded companies that have reached their steady state, another way to estimate the required rate of return is to simply take the dividend yield and add to that the annualized growth rate of the business. So figure out what is the annual growth rate of your business. Maybe it's somewhere between 2 and 3%. Add to that what is the dividend yield that you're able to give out to your shareholders, and that is the required rate of return. But this is only useful for large, well-established businesses. For companies that are growing very rapidly, it may not be an appropriate measure. You would then use the CAPM.
Thank
But I
you.
certainly urge the participants, if you have questions about estimating the cost of capital for your business, to turn to Mr. Flam's organization, because this is the realm of professionals.
Thank you. And we had a big thank you for answering that one. I believe this is jumping back to the last question I asked you, a follow-up, but would you run different scenarios for best and worst scenarios when calculating the IRR?
Certainly, certainly. So we have to check the robustness of our calculations. Obviously, nobody wants to risk $1 million or more on these projects based on just one spreadsheet, right? One table with cash flows and costs. We would have to do a scenario analysis. We would have to do a Monte Carlo simulation, which is run a simulation 100,000 times by changing the assumptions that go into building that initial spreadsheet. So where we had this table. So run simulations on this table by changing our assumptions. So there are a lot of assumptions that are behind these cash flows. I didn't go over that because I would have to spend several sessions on that. But having made those assumptions, you should tweak those assumptions, change it. There are so many assumptions that go into this. Change one assumption in one simulation, change another assumption in another simulation, and run these simulations, maybe 100 times, and see what is the average NPV, what is the average IRR, and see whether they meet the cutoffs.
Thank you. I know it's 1 o'clock. We have 2 more questions. If folks need to jump off, definitely feel free. We'll be sending the recording out. These should be quick though. What is the definition of payback and what is the definition of cash flow, free or operating cash flow?
Okay, so the first question is, what is the definition of payback? So payback is how long does it take? How many years does it take to recover the initial cost? That's the definition of payback. Okay. And the second question was definition of cash flow, free versus operating. So the operating cash flow is what I alluded to in my table in going from cash flow to net income. So cash flow is equal to, operating cash flow is equal to net income plus depreciation. Now, free cash flow builds off of operating cash flow. So for a simple formula for the free cash flow, that is equal to the operating cash flow minus the investment in CAPEX minus the investment in net working capital. So to repeat, the free cash flow is equal to operating cash flow. This is on a year-by-year basis, mind you. So on a year-by-year basis, the free cash flow is equal to the operating cash flow minus the investment in CAPEX minus the investment in net working capital.
Thank
CAPEX
you.
is capital expenditure.
Okay. Andrew, I've got one for you. Can the SBDC support clients in looking at how to use the DAB profile to grow their business?
I should reference the fact that we do have a terrific team that's based out of our Albany office. That is the research network. We do a wide range of market research to kind of help support and reference wide ranges of both data as well as spending patterns and other things with respect to businesses and prospective businesses. So if you have a specific question on that particular source, certainly reach out. So they have a wide range of access to different data sets that may be of use, and happy to explore that. And all of those services are available to all SBDC clients. If you're not a client already, I did put a link in the chat in terms of how to become a one-on-one client, and that would enable you to take advantage of those services as well.
Thank you. And Andrew, we got another question that I think would be for you. This was a great seminar. Are there going to be more? Not necessarily on this topic, but in general.
Oh, absolutely. Thank you for the question. We're glad you enjoyed it. We will be hosting additional sessions, our center directly, but I know that my colleagues throughout the state will as well. Next week's seminar that we're hosting will be on cybersecurity awareness. And then the following week, I believe we have a session on trade marketing. And there are a wide range of others. There's just two that come to mind off the top of my head. But yes, in the chat, you should find a link to the upcoming webinar calendar. And on that link, you should be able to access information about each of them and registration links as well.
Padma, did you have any last words before we shut down? Just good luck to all the participants, and I hope to see their names in the Wall Street Journal and maybe the company's listing on the New York Stock Exchange someday.